Hey everyone, and welcome. Today we're going to talk about something fascinating, Islamic finance. Now this is the global system, but it's built on one core idea that completely flips banking as most of us know it on its head. It's an entire ecosystem, all sparked by a single, really powerful rule.
So let's just jump right in with a big question. Imagine this. What would our financial world look like if you couldn't charge interest on a loan? I mean, at all. No interest on your mortgage, no interest on a car loan, nothing. That's the fundamental puzzle that Islamic finance sets out to solve. And believe me, the solutions it comes up with are incredibly creative.
So here's what we're going to cover. First, we'll dig into that core no-interest principle. Then, we'll break down three of the key tools that make it all possible: Morabaha, Ajara, and Sukuk. And finally, we'll look at how this whole system is actually fitting into the bigger global economy. Sound good? Let's go.
All right, so first things first. To really get how this all works, we've got to understand the why. What's the one rule that changes the entire game?
And here it is. It all boils down to this single concept. In what's called Sharia-compliant finance, which just means it follows Islamic principles, you can't make money from money. You can't just lend out cash and charge interest. And that one rule, right there, forces banks to get really creative. They have to find completely different ways to structure deals and turn a profit.
Okay, so let's check out the first solution. Let's say you want to buy something big, a car, maybe a house. How do you do that without a regular loan? Well, one of the most popular ways is through something called Morabaha.
And pay close attention to the language here, because it's important. A Morabaha is not a loan. It's a purchase agreement. The key words you'll see are costs and margin. Think of it like a totally transparent cost-plus sale.
So what does this look like in the real world? It's pretty straightforward. Step 1, you go to the bank and say, hey, I want to buy that specific car. Step 2, the bank goes out and actually buys the car. It now owns it. Step 3, the bank then turns around and sells that same car to you, but at a slightly higher price that you've both already agreed on. And then you just pay the bank back over time.
And that right there is the crucial difference, see? The bank's profit isn't interest, it's the profit margin on a sale. It's a markup from a real trade. They bought something and they sold it. This simple shift turns what would have been a loan into an act of commerce.
Okay, so that's how you might buy something. But what if you don't need to own it? What if you just need to use it for a while? You know, like leasing some heavy equipment for your business. Well, that's where our next tool, called Ajara, comes into play.
You can basically think of Ajara as an Islamic lease. It works like this. The bank buys an asset that you've picked out and then it leases it back to you. The key thing to remember is that the bank owns the asset the entire time.
The process itself is super simple. You pick out the asset, the bank buys it, and you pay a regular rent to use it. Now, this probably sounds a lot like a normal lease you're already familiar with, but it's the why behind it, the principle, that makes it totally different.
So here's the bottom line. The bank is earning its money from rent, a payment for letting you use a real physical thing that it owns. Again, notice the pattern? The bank is involved in a transaction based on a real asset, not just lending out money.
All right, we've talked about buying and leasing. Now let's switch gears to the investment side. Imagine you need to raise a ton of money for a huge project, but you can't issue a regular bond that pays interest. What do? Well, the answer is often something called a Sukuk.
Now, you might hear Sukuk called Islamic bonds, but that's a bit misleading because they're fundamentally different. When you buy a regular bond, you're lending money, but when you buy a Sukuk, you're not a lender, you're an owner. You're actually buying a small piece of a real tangible asset, like a share in a building or part of a power plant.
And this is really the best way to see the difference. A normal bond is basically an IOU. It's a debt. A Sukuk, on the other hand, is a certificate of ownership. You're a part owner. So what does that mean for your returns? Well, you're not getting a fixed interest payment. You're getting a share of the profits that the asset generates. So yeah, you share in the success, but you also share in the risk.
And that's the whole point. With Sukuk, your investment is tied directly to how well a real productive asset is doing. The money you make comes from that asset's actual economic activity, which keeps everything in line with that core principle of avoiding interest.
Okay, so this isn't just some niche theoretical stuff. We're talking about a huge and growing part of the global financial world. In fact, we're seeing major Western countries, big financial hubs, actually changing their own laws and tax rules to make room for these products.
And here's a super simple way to think about it. Think of Morabaha as basically cost-plus financing. Ajara
that's just a lease agreement. And Sukuk, they're a lot like an asset-backed security. Seeing these parallels really makes it easier to understand how they fit in.
So, how are countries like the UK and France handling this? Well, they're using a really smart principle: substance over form. Basically, they're saying, let's not get bogged down in the legal jargon. What's actually happening here economically? The whole idea is to make sure these Islamic finance products get a fair shake, tax-wise, and aren't at a disadvantage.
And if you want proof of how seriously this is being taken, just look at this. This timeline shows more than 10 years of hard work by regulators in the UK, a massive global financial center, mind you, all with the goal of making sure Islamic finance can compete on a level playing field.
And they took some really big steps. For instance, they created a whole new legal category called alternative finance arrangements. They got rid of tax problems, like being taxed twice on a property sale in a Morabaha deal. They even passed laws so the government could issue its own Sukuk. And on top of all that, they set up a dedicated task force just to champion the industry.
And hey, it's not just the UK doing this. France has been making big moves too. They've issued their own official guidelines to make sure their tax code treats things like Morabaha and Sukuk fairly, right alongside conventional financial products.
So, as we start to wrap this up, if there's one thing to take away, it's this. Islamic finance isn't some clever way to get around the rules. It's a genuine effort to completely reimagine finance from the ground up, built around that core idea of tying everything from a home purchase to a huge infrastructure project to a real, tangible asset.
And that kind of leaves us with a bigger question to chew on, doesn't it? As the whole world continues to look at and question our financial systems, you have to wonder, could these ideas about tying finance directly to real-world assets offer some valuable lessons for everybody? It's definitely food for thought.